Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hey everybody, welcome to the pod, welcome to the podcast. We are excited today because today is season 2, episode 1, and I've got a fantastic guest for everyone today. I've got Delphine from DPZ Avocats. She's going to talk to us today about issues between the U.S. and France, so cross-border tax issues that arise between the two countries, mainly from the French side. I will, of course, try to give you the U.S. side of the equation, as always. But without further ado, let's get into the podcast. Delphine, why don't you tell our audience a little bit about your education, background, licenses, all that good stuff?
Thank you, Mishkin, and I'm very delighted to be your guest for this season 2. And so myself, I'm a tax lawyer who have been educated at the University of La Sorbonne in Paris and the business school HEC. So I have a master degree of international tax, and then I passed the bar exam in Paris as well, and then launched my career in the big 4 law firms, because in France, tax advisory is handled by lawyers. So that's why I'm here as well. So this is basically, and after 5 years, working also from Paris and New York for transaction tax, I moved to south of France in Nice and set up a special boutique tax law firm dedicated to international groups and high net worth individuals.
Awesome. Yes, as you can clearly see, you are a very smart individual. And Nice is a beautiful place. I've been there a couple times. I can't say it's so lovely. There's not words to really describe that area of the world. You're also, though, a member of the Nexia International Network. Is that correct?
Yes, absolutely. I've been a partner of the Nexia International Network for more than 10 years now, and quite an active participant in the international tax conferences and the committees. And it's a fantastic experience because we can really work together, and Nexia is really keeps the independence of members and at the same time create human and professional links, which I find extremely efficient in the advisory world.
Absolutely. How long have you been a member with Nexia for? The Wolf Group, we've been with them since 2012.
Since 2014.
2014. Okay, so roughly about the same time. That's awesome. And I probably see Delphine probably once or twice a year at the conferences. We've had the pleasure to talk tax about various cross-border client issues, and we obviously refer each other clients. Let's get into some basics about French taxation, just so that we can give our audience some context here. So talk to me about how French tax returns are done. Does France use a calendar year, or is it more like a fiscal year? Do you file tax returns in France like we do in the United States? What are the due dates? Things like that.
You need to get a flavor of the French tax system. Regarding the calendar year, in principle, it's from 1st January to 31st December. Okay. And then we declare the annual tax return, both for French tax resident and non-French tax resident, at a date which is never fixed. So every year it's a surprise. It's in spring, and it's not the same date whether if you live in Paris or if you live in Nice, for instance. So basically, it's spring. It's a hot spring, but it's an annual tax return. And so everyone has to file a form 2042, and then you have lots of appendices similarly to what you have in the US. Okay. So specifically, The specificity is this form also includes the tax return for French real estate wealth tax. It's also applicable to non-French tax residents if you have real estate assets of more than 1.3 million euros.
Okay, yeah, and I want to get into that. I want to get into the French real estate and the wealth tax and all that stuff. We'll get into that here in a second, but let's just kind of keep focusing along the lines of income tax. Talk to me about, and I think you call it key specificities for a U.S. investor, but talk to me about maybe the most common or three most common, cross-border tax issues of a U.S. person coming inbound into France. Like if you had 2 minutes to kind of talk to a U.S. person and say, hey, these are the things you should be aware of if you're going to move to France, what would you say?
The first thing is to check all the structures for which there is a disconnection between US and French tax. The first one is regarding the LLCs or US partnerships, because it often triggers double taxation. So it's definitely not the type of SPV in any type of business or real estate, or it's because France is going to consider it in most cases as subject to French corporate income tax. And then based on the double tax treaty with the US, there is a difficulty to obtain the absence of double taxation with the US. So this is a really tricky topic. And so it's already to check the situation and to try to clean before arriving to France if possible. Another type of structure which can create some emotions from a tax standpoint regarding trust. I know we will speak about it a bit later, but also with respect to income tax, there will be a taxation on distributed income, and it's also something where double tax treaties are not a good protection. So this is basically the first thing to have in mind. The other thing to have in mind is to be very careful with a system and valuation system when you move to France. We have some, of course, issue regarding the French real estate wealth tax with respect to inheritance. Also, we have a double tax treaty with the US. It has some impacts because in France, you have quite a high taxation as from several thousand euros. So it's not like in the US. So it's to be careful of this planning before moving to clean. Then we have a subjective system, which is declarative, but the law is never very clear. We have lots of administrative guidelines. So it's always very important to look into the details. So just for example, when you have a pension scheme and clients wants to move to France for retirement, we have different system, and in certain circumstances, we can obtain a small taxation of 7.5%. Under other circumstances, can be more than 50%.
Oh, wow.
So it really needs to be anticipated. When it is anticipated, we can really minimize the tax very legally, but just because the clients are informed.
I see. So to recap, in my head, the first big takeaway is that if you're going inbound into France and you're a U.S. person, you need to do pre-immigration income and estate tax planning. Mm-hmm. My second takeaway is just like a lot of other countries outside of the U.S., you got to be careful with entities in the U.S. or trusts in the U.S. that are quote unquote transparent, right? Mm-hmm. So disregarded entities or S corporations, because France may treat those as similar to C corporations, and they want to impose a corporate tax where no corporate tax would exist in the right. U.S. And so then that creates a double tax issue because you're not going to get a credit for the corporate taxes paid in France against the individual income taxes due in the U.S. There are tax treaties between the U.S., from what I understand, both income tax and estate tax, or I guess in France it would be an inheritance tax. Those could work to your benefit, but you really have to kind of analyze the assets that are in the United States and kind of how they get treated in France to make sure that there's a corresponding setup that's proper in both places. And then trust planning sounds like it's the same principle as the LLCs. Again, in the United States, we may have a vehicle called a revocable trust, But in France, they may look at that as like an actual opaque trust, and they may want to tax that, under trust rules there, which could have consequences in the U.S. because that's not how we do it. So sounds like there's some key things there that need to be investigated. You just don't want to show up in France and become a French tax resident with all this stuff in hand and not get any advice.
If I can add one other takeaway, is to be very clear on the date of arrival, because once again, it's a declarative system. And if you remember, I just explained that in principle, the income tax year is from 1st January to 31st December. However, the year of arrival, if you really arrive in April, then your first tax year will be from 1st of April to 31st of December. And of course, if there is a significant operation in March, France can seek to include it in the scope. So this is where we need to be extremely consistent and to have a combination of facts to really show that it's that day that it was a transfer of the tax residence, and that was for in case of audit that we are fully prepared.
So if I come to France, say for like 30 days in February, under that same hypothetical, and I'm just kind of setting up my lease or rental property and kind of signing my work contract and all that stuff, but I'm really not going to move to France until April 1st. Does that create a little bit of a problem, because I kind of started the year in February, or can you make an argument saying, no, that person was just there temporarily and their real start date is April 1st? How does that work?
Well, it's exactly what you're saying. It really depends on facts. So as soon as you have a labor law agreement, this can be the date for your arrival, even if you're still managing your moving. And also, it's going to be important to be consistent because, for instance, if you arrive for a labor law contract, there is a possibility to have a very interesting tax incentive in France. So basically, it's a combination. So if it's a director, definitely the date of the beginning of the work will be really of the assignment will be the date to start, even if still dealing with the affairs or children coming to school a bit later. If the person is not working, then it will be more linked to the assets, what happened with the day maybe the clients have engaged to buy a property or to rent a property, and then it needs to be consistent with the date to be considered as French tax residents for bank statements. So it's very, very factual. When we have this type of audit, the tax authorities are extremely developed powers to check at which date it was. And this is something which is checked 2 or 3 years later based on the declaration. And of course, if they are aware about a specific transaction, it needs to be really clarified.
Sounds a lot like the United States. I always tell my clients that the taxing jurisdictions they're the opposite of the John Lennon song "Instant Karma." It's not something that immediately you're going to face, like you said, 2 or 3 years later. And then it's funny when I ask my clients, I'm like, okay, well let's combat this. We didn't develop the facts at the time because maybe you weren't my client. Now we try to go back and develop the facts, and all of a sudden they're like Mr. Magoo and they can't remember and they don't have any paperwork. So to me, this is very similar to the United States, where again, I will harp on this. Pre-immigration tax planning can pay off in multiple ways. The return on investment can be significant initially, and then it can help out later on. I think it's just so powerful, especially in jurisdictions where you have this subjective reporting, and the facts and circumstances mean a whole lot. I think this is really something that I would hammer home to the audience.
If I may add a comment as well that I think it's very useful. Is in France also the income tax is declared at the level of the household.
Okay.
So when you look at the tax residence, you look at both civil partners or the married couple. And of course, there are many questions today with the mobility, where the children are located. So France considers very traditionally that if the children are educated in France, this is the place of the tax resident in the household.
Okay.
And they are very reluctant to apply the double tax treaty with the US and any double tax treaty in case of audit. So when we really have dubs of situation, we can ask for a ruling, which is quite fast. It's 3 months. For France, it's fast.
Wow.
To really certify it, because of course there are many situations where the spouses live in different countries and where it's a very detailed factual analysis and not easy to conclude, and we need to have a guarantee for our clients.
Okay. And in the United States, we also can ask for rulings. They're called private letter rulings, but they're very costly. I mean, they can be $80,000 US, and that's not the fee to the advisors. That's the fee to the IRS. Do you have to pay for a ruling in France other than the okay? So that's a
no, not for now. You know, maybe it's a good idea for the new government who is seeking for 60 billion, but no, today it's a free.
Okay.
It's only the lawyer to pay.
Lawyer fees. Okay. All right, got it. So it sounds like I made a proposal to help out the raising of revenue in France. Okay, let's quickly talk about, and I don't want to go too deep into these, but I would feel remiss if we didn't talk about it, because I think this is cutting edge, especially because we have the new model treaty coming out in 2026, OECD model treaty for 2026, and that will maybe drive some of these areas. But talk to me briefly about the take in France, or the heartbeat right now on digital assets, cryptocurrency, NFTs. How is France dealing with this area when it comes to tax? Do you feel like it's a thought leader in the area? Do you feel like it's playing from behind? Just general comments on that, if you would.
Well, France is quite, I don't know if it's obsolete or traditional.
Okay.
But since the beginning of the cryptocurrency and NFTs, they look at French tax residents, and they tax the capital gains according to a flat rate of 30%.
Oh wow! Okay.
If it's a regular transactions, then it's considered as a business, and taxation and social contribution can go up to 45%, maybe even more with the future finance law.
Okay.
And you have a requirement to disclose your cryptocurrencies in a specific form in your income tax. So it's quite, and there is no VAT because today it's considered as financial instruments.
Okay.
So this is quite traditional. Of course, it doesn't apply to all issues related to the location of cryptocurrencies and NFTs, but this is how it acts. I think today they really try to gather information thanks to this obligation of accounts filing, but we have not. There are not so many tax audits yet on this topic.
Yeah, no, it's definitely cutting edge, and similar to the United States, we also kind of have to disclose the crypto. There's a question, or really, we call it an SAT question here in the United States, where it's like a 10-part question you have to answer at the beginning of your tax return, and then we have different ways that we look at different types of digital assets. We consider it like personal property, similar to like a desk or a chair. So I think if you're considering it a financial instrument, we probably have a double tax issue that can't be alleviated under current tax treaties. And then
yes, you're right. I mean, yes, I think we may have some discrepancies between the qualification, because France is going to consider it as a movable property.
Right. Okay. Yeah. So that's a really interesting issue. And then the one thing I will point out is France actually has a fantastic agreement under FATCA, where a lot of the French pensions and certain French accounts are exempt from reporting. But obviously that comes from 2011, 2012, way before the kind of cryptocurrency, kind of hit in. So if you say, for example, that the digital assets, cryptocurrency, quote unquote, accounts are located in France, or maybe on a server on a computer in France, then I would tell you need to disclose that voluntarily on your individual income tax return in the US on Form 8938. So there's that's an interesting area. Let's move on to another interesting area very quickly, because I just did a webinar with Nexia, with some of our firms from the UK and Poland on influencers, athletes, and entertainers. Any special things, because you just had the Olympics out there, and I was sitting there watching, the games, and I said, that looks like maybe someone gave, a Louis Vuitton bag or something to that Olympic athlete. I wonder if that's going to be a taxable, gift to that person. Anything you want to give us? Any kind of, guidance or comments on the taxation of those folks?
I think we need to differentiate athletes and influencer. For athletes, it's really depend on their contracts.
Okay.
So most of them have wages, and then they structure the royalties via a structure. Of course, we have to check that the structure is not totally passive and is not only a mailbox. Then in other sports, they are considered as business income. So there is no specificities with this respect, except that yes, the type of structure for the royalties and for the rights related to the brands that they represent and their image rights, of course. There is a good regime that is not very known. As I said earlier, when a person becomes a French tax resident, and if this person has never been a French tax resident over the last 10 years, they can benefit from the impatriation regime. So it's often basically it was set up for traders when at the time President Sarkozy wanted to compete with the London place. But in practice, it really benefits to athletes, to football players, notably, and because they can obtain 30% reduction on their tax and on many exemption regarding their income from abroad, and for 8 years.
Oh wow! Okay.
So this is for the athletes. For the influencers, the topic is much more, I would say, is much more under the shadow, because the question for me regarding influencer relates to the fact that they are digital nomads.
Yes.
And I'm afraid that 99% of the influencers, at least in France, forget about this, and are not fully aware about this obligation and the mobility, and definitely the question of having a consistent tax residency to disclose the income in the correct location. Because as you know, we only have I think Spain is doing, has implemented a specific regime for digital nomads.
Yes.
But I think it's quite rare. So.
Yeah, so I think the digital nomad tax regime and rules and issues, that's a fantastic topic that you brought up. Thank you for doing that. I think that's another area that a lot of countries are grappling with. I know in the United States, we have yet to even crack the code on that with the mobility between the different states. There's still a lot of issues. We have convenience of employer rules in New York that throw everyone for, a loop. So this is an area, again, influencers, I think, digital assets, digital nomads. I think those three areas are going to be really keen and interesting to watch over the next couple of years on how those develop. Okay, let's get into some meat and potatoes, as I like to call it. Tell me about your thoughts, whether you're a resident or non-resident. What should we know about investing in French real estate? Talk to me about that. Oh, and also, sorry to interrupt. Also, tell me about SCIs, because this is something so common. We see this all the time in the United States. Everyone's got an SCI or 10 SCIs. It was the running joke at the last Nexia conference. I was sitting with some folks from France, and one guy reached over and he said, "Hey, I've got like 6 SCIs." And I go, "Well, if you became a U.S. tax resident, your tax return would blow up." So okay. Tell me about those two things.
So thank you for the challenge, Mishkin, because the challenge is to not make everyone fall asleep after this topic.
Okay.
To take and also to be quite clear with the scope of this very interesting area.
Okay.
First is regarding the taxation regarding owning the asset. Okay. When you invest in a French real estate asset, very good news. You pick the notary of your choice, public notary.
Okay.
The price is including in the transfer duties when you acquire. So even if the seller has already a notary, at the end they split the price into the two of them, and each of the client has the advisory. So this is something which is very protective and very important because, of course, you need advisory, but they can really, if you feel buying a property in France, you can really make an offer with the agency, and then you have a contract with the notaries. So this is where you start being engaged, and then there is a final deed. And between the first contract and the deed, you have time to set up the good structure. This is the first thing. Another thing which is important, sorry, it's not directly taxed, but I think it's important. In France, we have the land office, which is an absolute guarantee regarding the ownership. When you meet someone, you make an offer, and it goes to the public notary, you have no doubt that this person is the owner of the real estate assets. You don't need an insurance for that. It's included. So that are the good news.
Okay.
It's indeed very important to structure well before the deed, because any post restructuring after the deed will trigger at least transfer tax and notary fees, which are approximately 7% of the fair market value. So it's better to check it before, because then when you want to change, it's a significant cost.
Oh, okay.
There is no real optimization of owning the real estate today in France. So I'm sorry to say that. It's more to avoid having too many costs and to incur tax fraud because you were not aware about the very heavy compliance.
Okay.
So if you invest in an asset depending on the use of your assets, it will be more or less simple. So during the holding of the assets, if the asset is more in total in France, more than 1.3 million euros, you have the French real estate wealth tax. You have to make a specific declaration every year. The rate is up to 1.5%, and it's a progressive scale. So it's a quite significant tax. You also incur land tax and residence tax. The amounts are defined by the local authorities. So depending on which city you live or you buy, it's not the same. It's not the same price. Then, if you rent, you will have income tax. If you have a structure which if you purchase through a SCI and you want to rent furnished, the structure will be subject to corporate income tax. So basically, the SCI is interesting to just as a SPV to manage the real estate assets between the shareholders, and it is interesting if indeed you apply what we call the dismemberment of ownership, where you can transfer to your children or to person of the family with a reduced basis. So the reason why the SCI is quite used is because it helps the owner or the parents to buy a property, to manage it until their death, and then to limit the tax cost upon inheritance. But compared to what you have in the US, well, I'm afraid I don't agree with other practitioners, but SCI has absolutely not a revolution or a fantastic vehicle. It's just easy to manage.
I see.
As soon as what you don't have, what is really not recommended is to purchase French real estate through a US vehicle or any non-French vehicle.
Okay.
For the reason I mentioned before, you have more taxation, but you have also more compliance requirements with a 3% tax return. So every year you have to declare on a specific form by the 15th of May the value, the beneficial owner. If you miss the timeline once, it's okay. If twice, you pay 3% of the fair market value of the property for 6 years with 40% penalties. So I would say today, having a vehicle when you invest in France, you really need to know to do it for other purposes than tax.
I see.
And so this is what I can say for, and then of course for inheritance tax, it's reduced basis because you could deduct some of the shareholder accounts under certain circumstances.
Got it. And so in the United States, just to be clear, the SCI, my understanding is that there's unlimited liability. It doesn't limit liability in France. Is that correct?
Correct.
Okay. So in the United States then, because it's a multi-member, generally it's a multi-member entity, that defaults to what we call a foreign partnership. That requires the filing of Form 8865, which is quite complex, especially given the new K2, K3 reporting in the United States. It carries a $10,000 penalty on an annual basis if you don't file it correctly or you don't file it at all. So similar to kind of what happens if you own French real estate in a foreign company or a foreign trust, you're playing the lottery there that, you may miss a filing or not do it correctly. And then you've got all sorts of penalties and costs associated with just paperwork. So a real big issue there. But I guess my takeaway here is that the SCI generally helps with the inheritance tax in France, which it sounds to me, and we can kind of dovetail into this, it sounds to me like in France, you really want to give away a lot of your assets during your lifetime to avoid the inheritance tax, which is kind of the opposite of the United States, where we like everything to pass at death because we have what's called a step up in basis, where the asset steps up to the fair market value at the date of death. So there's that kind of disparity between the two jurisdictions, but I believe that is resolved under the U.S. and French estate tax treaty. Do you want to give any thoughts or comments about the gifting strategies or the French inheritance tax or any of those issues?
Yes. First, there is no we have gift tax and inheritance tax.
Okay.
So if during your lifetime you perform gifts, basically the rates are exactly the same. The rebates are the same. The difference is like upon death, there is no inheritance tax between spouses and partners.
Okay.
Whereas if you do gift during your marriage, they are taxable.
Oh, okay. That's interesting.
Then we have, it's a progressively rate from upon 8,000 euros of assets. Up to 45% if it's between parents and children.
Ooh.
France is very, very traditional because if you want to if you want to have heirs who are not in your family, it's 60%. Even your brothers and sister is 60%.
Oh my goodness.
Gifts or inheritance tax. So the brackets between France and the US is so different, and yes, inheritance tax is very, very costly. So for smaller assets, there is an allowance of 130,000 euros every 15 years between each parent and each child. So it's very minimum.
Okay.
The main way of reducing the inheritance tax is what I started to explain about splitting the ownership of the property between what is called a usufructus and a bare ownership. Basically, you have an asset which is value 100. Depending on the age of the person who gives, you can be taxable only of 50% on the value, although you transfer for the future 100%. So this is really the main mechanism which applies to reduce. Of course, don't think about a trust with France.
Right.
If you have a trust, not a good idea. Maybe a good idea from a US perspective, but from France, it's abolished all what I said, which means it's extremely high tax costs. When I say high, it's 75%.
Oh my goodness.
Plus the declarative mechanism. So it's definitely not a way to handle French assets.
I see. Okay, so trusts are a no-go in France. The usufruct is very interesting. Here in the United States, we derive our law about usufruct tax laws from Louisiana.
Mhm.
That's the only state in which we see that in.
Linked to France. It's
Yes,
because
yeah,
it's linked to
absolutely.
France, yes.
Absolutely, yeah. All the law comes from France, and we see usufructs though. We see them a lot in South America, all over South America. We see them in other countries like Austria, for example. People like the usufructs out there. In the United States, we look at that usufruct, and just so that everyone understands what a usufruct is, or at least my interpretation, is that the person that gets the usufruct is the bare owner, right? So, like you said, they get transferred 100% of it. They're the bare owner, and then say the parents have a remainder interest to maybe the income or certain types of use of the property or things like that. That's the way that we look at it. And in the United States, the tax law is not very well developed in this area. And I always tell people, the practitioner kind of version of this is that we've come down to basically three things, right? Either it's a foreign estate, which you then report on Form 8938 under FATCA. It's what we would interpret it potentially as a grantor trust or a non-grantor trust, and then a foreign grantor, foreign non-grantor. Now, you start getting into foreign grantor, non-grantor trust reporting, you can get extremely complex, and really, then you really have to look at how is the usufruct written, and the bare owner, typically the child or the person that's going to inherit the asset at death. You really have to then check to see, okay, well, what obligations does that person have to maintain the property, to care for the property, things like that. Those are things we don't want in there, because if you start putting that in there under our regulations in the United States, we tend to start looking at more as a trust relationship or a de facto trust. So we got to be very careful when we raise the usufruct issue, because again, not a very well developed area. Any other comments before we move on inheritance?
For inheritance, maybe once again it's linked to tax, and it's important is since EU regulation of 2015, when you have any person who died, the place of location to allocate the assets and to recognize the allocation of assets, France recognized the place of living of the deceased. And then it is split and taxed according to where the location of the person, where the heirs are located. So if you are a heir beneficiary from an inheritance, and if you live in France for more than 6 years or 10 years, you can be also taxable, even though the deceased had no assets in France or had no nexus to France.
I see. Okay, very good.
So inheritance, basically, it's not a good place to die with France. That's a good place to live, but not to die.
And funny enough, quick side story. I had a client, a very wealthy client, that was from Switzerland that died in Chamonix. And it was a nightmare and it was a US person, oh, by the way. And it was a nightmare trying to deal with France, Switzerland, and the US on the estate and the inheritance taxes and all the stuff that had to come out of there. So I agree 100% with that last comment. Do not pass over France. Okay, moving on. There's one thing that I really want to bring up from the US side. I think this is really important that a lot of people don't realize. But there was a big change in 2019. The US and France the two governments got together, or the two, I should say, the two sides, the folks that kind of run the treaty. And one of the things that they agreed upon was that in France, you have these social taxes, and I'm not even going to try to pronounce the names. I apologize, my French is awful. CSG and CRDS are the names of the taxes. But prior to 2019, when someone would say, well, what's going to happen if I move to France? And I would tell them, well, just the income tax rate is probably going to be lower than the US income tax rate, because we don't recognize the social taxes for foreign tax credits. So you're going to always pay the higher of the two, which would be the US. But now in 2019, they came to this agreement and they said, well, look, we're going to consider those two social taxes as not social taxes. And basically, we're going to say that they're income taxes for purposes of the foreign tax credit. So now when you add those in, the French tax rate is higher than the US income tax rate. So generally what I see is when a US person moves to France, the French taxes are going to wipe out all the US taxes under the system of foreign tax credits, with a couple caveats. We have the net investment income tax and self-employment taxes that can't be offset with foreign tax credits. But Do you want to make any comment? And this is a massive change, because now from 2019 moving forward, you get these new credits. And then in years prior, if you weren't able to take those credits going 10 years back, you can actually amend tax returns and get refunds, which I don't think a lot of people know about. So that window,
it's a huge opportunity. Yes, it's really a huge opportunity for your clients.
Yeah. What are your comments on this? What are your thoughts on this? I just want to get a quick
Okay, I'm going to breathe because once again, France can be very innovative with concepts.
All right.
In principle, in the public finances in France, the difference between a tax and an impôt is not the same. So in US, we only have one, which is tax. So already we have two words. Then we have social contribution. So in principle, the impôt, like income tax, is supposed to finance the public budget. Okay. Then when there is a tax, it's, for instance, for many years, we had a tax on TV. Owning a TV was triggering a yearly tax for each TV owner. And a tax is a tax dedicated to a certain expense.
Okay.
And then we have social contribution. And I think indeed France is maybe the only country in the world where we apply social contribution on income which is not labor income. Of course, it applies to labor income, but we have social contribution on almost any type of income: capital gain, investment income, replacement income, employment income. Why that? The CSG, the first one that you mentioned, the general social contribution, was implemented more than 30 years ago to finance a minimum living wage for people who were unemployed. It was supposed to be temporary, and it was not temporary, and the rate was very minimum in 1986 and 88, sorry, and now it's extremely high. It's 8.2%.
Oh, wow.
Then very similarly, a few years ago, then the government needed some money. So to notably reducing the social security debt, and they created this new CRDS, repayment contribution for the repayment of social debts. Once again, it was supposed to be minimum, to be temporary. It's not minimum, it's not temporary.
Okay.
This question triggered a lot of case law at the level of the EU, because of course EU residents were not happy to contribute to French social contributions. So based on EU, it's after EU decision from De Ruyter a few years ago that France has decided that these social contributions were considered as taxes. It's quite, it's since 2008, basically, that France consider all the time that that these contributions are income tax.
Okay.
So basically for us, yes, you're right. It's France applies it with many illegal application when you look at the health system and at many, well, even at the treaties. But definitely in most cases, in all the renewed treaties, both countries have considered it as an income tax. But for instance, I took a few notes where several countries do not recognize it, like, for instance, the French-British tax treaty of 2008 excludes the possibility of offsetting CSG and CRDS against tax levying in the UK. So basically, France applies it, and then it depends on country. And so I think it's excellent news for US cross-border France-US residents to have this possibility, because it was a high cost.
Okay, fantastic. And if I'm self-employed, am I paying these taxes directly, or there's additional social taxes that I have to pay on top of the CSG and CRDS?
No, if you are independent, you are going to be withheld with other taxes as a social contribution for the health system. So basically, these taxes apply to employment income, replacement income. They apply indirectly in the independent income. It's just that the rate is much higher. Investment income and capital gain, real estate capital gains and everything almost.
And in France, you have the concept, I think it's called auto-entrepreneur. Is that right? Is that what most self-employed people do? Okay, so in the United States, I just want to make the point that if you're self-employed and you're in France and you're paying these social taxes, I believe you can get a totalization certificate from the French government. And then if you have that, you include that with your U.S. tax return. And then you're not subject to the U.S. self-employment taxes, which are 15.3%. So one of the planning mechanisms inbound into France, if someone's going to be self-employed, I always tell them, make sure to go, make that application. Is that something that you help with, Delphine? Have you helped anyone get that before, or is that something?
Yes, yes, definitely. Except that this regime is quite, it's for income less than 70,000 euros, and you have VAT. So it often happens that the threshold is, but definitely we assist clients for this type of cross-border issue and to obtain to have this possibility to offset.
Okay. All right. Let's go into one last question. It's a big one, though. So the world is changing all over the place. So the United Kingdom coming up later this month on the 30th of October, they're going to release their kind of take on their new tax laws. Obviously, in the United States, we have our election coming up in early November, and then our tax code, the Tax Cuts and Jobs Act of 2017, sunsets on December 31st, 2025. So the likelihood that we'll have a new tax code in the U.S. as of Jan 1, 2026 is quite high. We're calling that Tax Armageddon here in the United States. We love our drama, obviously. You've got something similar going on in France. You've got a budget deficit. I think you mentioned at the beginning of the podcast that the French government wants to try to raise 60 billion euro. You've got issues with, I believe, the prime minister that was chosen recently. Can you just walk us through at a high level, talk to me like I'm a 3-year-old. What's happening in France? What should we expect for tax changes? What should we know about what's going on there?
So first of all, except if we have a new revolution, there will be no shutdown.
Okay.
Because the French Constitution from the Fifth Republic guarantee that in case of it never happened before, but in case of disagreements before the year end, the previous budget will be renewed. So this is, I think, quite a good protection in that sense. You perfectly mentioned that I think the decision of the dissolution of our parliament by decree of the 9th of June 2024 was not expected by anyone. It seemed that it was a decision from Mr. Macron after the result from the European election, where his party came into third position.
Okay.
And so in France, in principle, yes, we have a presidential regime, which means that in principle the parliament should have a majority for to have a prime minister and to be able to govern, and the president should only be there for international affairs or in line.
Okay.
And based on the result of the election, second round of the 7th of July 2024. The result was not expected. In first, we had the left wing, which came first. Then there was the far right, Rassemblement National, and then the other parties. So I think it was during the just before the Olympics, but it took more than 2 months for the president to choose the Prime Minister Michel Barnier, who comes from a party who arrived third at the election.
Okay.
Can you still follow me?
Yeah, no, I'm still following you. So Barnier was chosen over Lucie Castetz, which is the far left, right?
Was the far left. Yeah. And in principle, I mean, what everybody was expected is like, okay, we don't know how it's going to be governed, but you should pick the first party. And then it's their engagement. When I say you should, it's based on our constitution.
Right.
You should take the winner of the election, and then it's their responsibility to have a government.
I see.
President Macron took another option, where basically he has to make a link with the far right party. And all the decisions are going to, governed by this alliance, which is not an alliance. It's just that he has to have the majority of the parliament. And of course, as he has no majority at all, either he go with the left wing or the far right. And for now, he's closer to the far right than the left wing.
Okay. So that could come back to bite him, though, right? Because I mean, the left wing could in the future then take over at some point in time. Is that correct? Would you interpret it that way?
I think it may come at the first. Except if there is a dissolution of the parliament.
Okay.
For now, they have no power to govern.
I see.
Because it's a liability of the president to nominate the prime minister, and there have been some measures to try to challenge President Macron, to destitute him, but it didn't go further. So very likely the budget is going to be voted. I'm speaking, we are, it's registered today. It's tonight that we are supposed to receive the finance law for 2025.
Okay.
So of course I have some information I can share.
All right.
But to tell you that maybe at the time of the display, there may be some evolution and some progress.
Okay.
So what happened is like they want to focus. They seem to want to focus on the companies with over 1 billion, with a corporate income tax of 30.25% for companies of more than 3 billion euros. Okay. And also increase corporate income tax for the one of 1 billion. Basically, they want to focus on the biggest 300 companies. Then they want also to focus on the wealthiest individuals, on 0.3% of the population, by increasing a minimum income tax rate for the one who are over who own more than 500,000 euros a year.
Okay.
They want to implement specific tax on the airplanes, on the ship owners. I don't know the rate. I don't know how they want to implement it now, but this is what they consider to implement. And then they want to take other reforms, such as not increasing the pensions, because in France we have a general regime. It's not like in the US. It's not private in France.
I see.
They want also to reduce the R&D tax credit benefits. So this is something important.
Yeah. Well, that all sounds very interesting. And also there's some parallels there to the US. I mean, in the US, we kind of have the cutoff line for what we call high income earners at about $400,000 US. We do have a lot of scrutiny right now on people that also own jets or airplanes, but that's less on the tax of those and more on the improper use of them. There's also a lot of talk here in the US. Obviously, we're not, we don't have to comply with OECD Pillar 2, but, at some point we have to consider our corporate tax rate and if that needs to come up, which is really funny because, with the Republicans, who are the ones that championed our flat 21% rate, have said that there are no sacred cows, if you will. And so there's been talk that our corporate tax rate here in the U.S. could jump maybe to even 25%. And that would be maybe more in line with what OECD Pillar 2 is trying to accomplish worldwide. So very interesting stuff. And if you put out any blog posts or any papers on the changes that are happening or things that come out, please let us know. We'd love to link those to the podcast. Let's wrap up here. So if someone wants to get in touch with you, they want to maybe come to you for a consultation, maybe pre-immigration tax planning, maybe have your firm prepare a tax filing for them. Tell me how you work, because a lot of times I think a lot of people don't work with professionals very often. They don't normally, understand how the process works, how to engagement letters work, timelines work. How does it work with your firm? How do you generally onboard a new client and then deal with that client? And how can someone get in touch with you?
So we always initiate a 15 introduction call
Okay.
to ensure that the client can raise the question, that we can ensure that we have the relevant offer to meet his needs. So we can be contacted by emails. I guess you will have the details on the display.
We'll link it all to the show notes. Absolutely.
So by email to say, okay, I have an issue, I would like to speak to you, and then we have a 15-minute call. Then most of the time we propose the first step of making a synthesis of the situation as of today. What are the French tax impacts of the situation? And from this analysis, what we do is then we provide a really defined offer with all the steps to anticipate as far as possible with a fixed budget. This is the way we want to work. And of course, we include, this is quite new, but I think it's something that you do a lot in the US. I do more and more WhatsApp and calls, regular calls to adapt, because I think it's what is important is that the client have the information, know what to do, can take their decision, and can take liability of their choice. Whether maybe having a very long memorandum maybe not be useful for them.
I see. Okay, yeah, that's fantastic. So similarly at the Wolf Group, I mean, we somewhat follow that. We do the 30-minute discovery call, although I kind of like the 15 minutes. I think that may actually be a bit more powerful. But then we do typically, it's like you. I think what you described, we do a step 1, step 2. So step 1 is really, where are you at on the map? It's a low-level engagement. It just kind of, where are you at? What are your issues? What are we going to go into? And then what's the actual service going to look like? And then step 2 is like the actual, like, let's get in the weeds. You've picked out kind of what you want us to do. You understand the fees associated with it. It could be consulting. It could be compliance. It could be a wide variety of things in between. And then step 2, we kind of do the actual meat and potatoes work, as I like to say. And then I think you're exactly right. Sometimes when people we issue technical advice memos, it's overwhelming. I mean, some of our documents can be 30, 40 pages in length. And sometimes they just want that distilled, I always try to ask someone, are you a bottom line person? Are you, do you just want like the summary? And so in that regard, sometimes we just like to we give them the memo, obviously, but then also we kind of do a high level summary and a debrief meeting as well.
And of course, for instance, to give you the arrival of a footballer in France, we really include the analysis, of course, the tax resident, we include the incentives, and then we make a regular follow-up call and to anticipate, of course, the tax declaration. So we try to really give comfort and clarity and certainty of what the next steps in this environment, which is new for the clients. And of course, we send an engagement letter to be very clear on our terms and conditions.
I see. Okay, very cool. Well, Delphine, it was such a pleasure to have you on the podcast today. I learned a lot from you. I hope that our audience had 2 or 3 big takeaways that they can use in their day-to-day activities. Would love to have you back on the podcast when things develop in France and we get something new out there. There's some other topics that I really want to go into with, but I'm going to leave that for another time. So I just want to say thank you so much for being on the podcast today.
Thank you very much.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.